Hello, very good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Tuesday, the 30th of January 2024. So before we start our Daily Dose, let's have a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook that I usually share for the broad-based cross-asset classes ranging from the benchmark stock indices, the major FX pairs, gold, XAU/USD, and as well as West Texas crude oil, let's have a recap of what happened yesterday. That means, i.e., what took shape yesterday in terms of economic events and data releases, and as well as the performance of the broad-based asset classes. So let us start with the performance of the broad-based asset classes first. So what we could see yesterday is a very strong risk-on behavior across the board in the major US stock indices. So that came in within our expectation for those who actually follow us in our daily dose of market insights, where I covered the short-term technical outlook on the major US stock indices. All of them actually move within that bullish trajectory, with the SPX, the Nasdaq, the Dow Jones Industrial Average, and the Russell 2000 all actually recorded positive gains yesterday, with the top performer being the growth-oriented, we call it Nasdaq 100. We have a gain of positive 1.01%. Top performer Russell 2000, positive 1.67%, and followed by the SPX, which is the S&P 500, up positive 0.76%. Then followed by the Dow Jones Industrial Average, which is kind of lagged behind, but still managed to have a gain yesterday of 0.59%. And one of the reasons why yesterday the top performer is the growth oriented, and as well as the small cap Russell 2000, is due to the fact of a lower US Treasury yield. That means the 10-year US Treasury yield actually inched downward yesterday, primarily due to the reason of the US Treasury actually projected a lower funding requirement for Q1 this year and as well as Q2 this year. So what do I mean by this? So if I were to look at the screen, let me share with my screen over here. This is the headline news that took shape yesterday. All right, so overall what we could see over here is that if you look at my screen, the US Treasury actually projected to borrow 760 billion in Q1. That is lower than October forecast. All right, so that was actually 55 billion lower that was forecasted in October earlier. And also they also look to expect to borrow 202 billion in Q2 this year over here. So that's actually much lower than 760 billion projected in Q1. So net, right, the funding requirement for the US Federal Reserve as a whole aggregate has started to dip down. All right, so when it starts to dip down over here, what it means that it actually require a lower a yield to a lower, what we call it, a yield to be issued in Treasury bills or Treasury notes going forward, because my funding requirement now is much lesser. So that actually cause a Treasury, the current Treasury yield to be lowered, because right now my borrowing requirement is much lesser. So I'm telling the market that I don't need to borrow as much as I used to do in the past. All right, so that causes the Treasury yield. If you look at the Treasury yield, like share with you all, okay, this is the US 10-year Treasury yield, which is a benchmark for longer term funding costs globally. It has started to inch downwards and back below the 200-day moving average, and right now retesting the 4.06% level. Okay, but all in all, what you could see over here is that daily RSI has really started to shape a bearish breakdown below a former parallel ascending trend line support level that I draw from the low of 27th of December over here. Okay, so it starts to break down below the 50 level mark as well, so indicating to us that there is some kind of medium-term downside pressure that is building up on the 10-year US Treasury yield. That means there's a risk that the US 10-year Treasury yield may start to resume its impulsive down move over here. That means, i.e., there could be a breakdown below 4.06 to actually retest 3.79%. So that actually is a very positive catalyst for risk assets. Why? Because, i.e., lower cost of funding. Once you have a lower cost of funding, that means, i.e., profit margin will start to expand as well, especially for Russell 2000 related Russell 2000 index, where majority of the component stocks inside the Russell 2000 small cap index are dependent on debt to actually maintain their business operation, and for sure also for long duration proxy, which is the Nasdaq 100, that is actually explaining their outperformance yesterday. But nevertheless, we also bear in mind that this coming Wednesday was also pretty much key. Why? Because this coming Wednesday we will see the release of the US Federal Reserve, we call it announcement. I mean, i.e., there will be likely no interest rate cut at this juncture, but market will be paying very close attention to the monetary policy statements for forward guidance, and as well as Federal Reserve Chairman press conference that is 30 minutes later after the announcement of the FOMC outcome. So market will be paying much attention to his press conference on any signs of indication or what he's looking out for to enact the first interest rate cut for the Federal Reserve in 2024. And also do not forget, on Wednesday itself, yesterday we have the announcement of the projection of what the US Treasury is about to borrow in Q1, 760 billion. So on Wednesday, the US Treasury, in conjunction, with, I think roughly it's around the same timing with the US Federal Reserve FOMC announcement. I think it should be 3 a.m. Singapore time, or 2 a.m. Singapore time. Roughly this time, I got to get exact timing before I can share with you all tomorrow morning. How are they going to fund this 766 billion? So previously, right, in October, why the US stock market rally as well? Because they, in previously Q4, they actually funded using short-term treasury bill instead of the notes. So if this time around the US Treasury continue to fund using short-term treasury bills, that could actually also give a bit of liquidity injection or liquidity elevation, easing in the funding markets. Why? Because that could actually also put some downside pressure on the longer term treasury yield, because or even the notes, because they are not using it to fund via longer term notes. So they're using the 3 months and 6 month treasury bill to fund their requirement. That was actually happened in Q4. So this time around, if the US Treasury continue to use this operation mandate to fund this 760 billion projected amount in Q1 via treasury bills instead of notes or bonds, that could actually see also further downside pressure on the longer term treasury yields as well, which i.e. could be positive for the ongoing risk on behavior. All right, so that is the key we call it news and announcement I shared with you yesterday. For now, what we see over here is that dollar was kind of sideways yesterday as well. So then you have gold inching up slightly higher, and West Texas oil managed to inch down much lower after hitting that key medium-term resistance at 78.40 US dollar per barrel. So now with that, let us start off with the benchmark major stock indices technical outlook. All right, since I already covered much ground on what happened yesterday, I want to share with you all. Okay, now let us start with the Asia market first. So on the Asia market, Japan 225. So Japan 225 continue to inch higher, shaping higher low. What you could see over here, holding above the first support at 35,745. So let me expand my screen so that you guys could see. Okay, so with that, right, I do not want to put it so tight at 35,745. I'll still be using 35,350, which is also conversing with the upward sloping 20-day moving average. So as long as 35,350 short-term pivotal support holds on the Japan 225 over here, we will still maintain that short-term bullish outlook. The first resistance to watch will be at 36,540, followed by 37,000 figure level, which is the swing high of the 23rd of January 2024. Above it sees the medium-term resistance coming in at 37,480, which is so confluence with this light green line over here. This light green line is in fact the major ascending channel top, taking from the low of 11 of Jan 2023 low. All right, so that will be the top of the channel, which is so confluence with a cluster of Fibo extension level as well, all at 37,480. All right, so with that, no change, still maintaining that short-term bullish bias on the Nikkei 225 or the Japan 225, as long as 35,350 holds. If we start to see an hourly breakdown below 35,350, then we would invalidate this short-term bullish bias to kickstart another round of minor corrective decline to test the next support level at 34,840. Then now what's next for the other Asia benchmark stock index will be the Hong Kong 33. So Hong Kong 33 managed to shape that pullback, now still holding above the 15,660/15,530. So as long as 15,530 short-term pivotal support holds, we will still maintain that short-term bullish outlook for another round of potential minor corrective counter trend rebound to retest 16,220, which is the minor swing high area of 24th of Jan. That is now I think as a minor range resistance. Only a breakout above 16,220 exposed the next intermediate resistance at 16,525. We saw confluence with the 50-day downward sloping moving average, and as well as the minor congestion area from 3rd of Jan to 6th of Jan. All right, that's confluencing at 16,525. However, if we start to see an hourly close below 15,530, then we will invalidate this short-term, we call it minor counter trend corrective rebound scenario to kickstart another impulsive down move to retest 15,000 support level in the first step. All right, so overall, right, what we could see the Hong Kong 33 over here is that it hasn't really surpassed the 50-day moving average, and as well in the last week or so, given this strong push up over here due to a liquidity injection by PBOC, and as well as various measure to actually elevate the ongoing rot that is being seen in the benchmark China stock market, and as well as the Hong Kong benchmark stock indices. But all in all, right, whatever bounce that we see over here so far is only minor counter trend rebound within its medium term and major downtrend phases. Okay, so support level to watch, no change at 15,530 to maintain that potential ongoing short term counter trend rebound scenario for the Hong Kong 33. Now moving on will be the European index, will be the German 30. So German 30 going to print higher high, and yesterday it managed to stage a bullish breakout above 16,970, which are within our expectation. So what 16,970 is in fact the range resistance excuse me, that was formerly in place since 14th of December, tested on 2nd of Jan at the start of this year before shaping that corrective pullback. And right now it starts to shape a series of higher high and higher low, and continue and start to evolve within this medium short-term impulsive ascending channel from the low of 17th of Jan that I drew right over here. And if you look at the daily, the hourly RSI, it also start to shape a bullish breakout from this range configuration as well that I draw. Okay, yesterday. Okay, then all in all, I don't want to use 16,970 as my short-term pivotal support for today. It's too tight, so this will be like a pullback support. Any pullback that's managed to hold above 16,850 level, this congestion area over here, okay, formerly minor swing high, now turns to the pullback support that was tested yesterday, where it shaped a higher low. Okay, from yesterday, so 16,850 short-term pivotal support for any signs of pullback. As long as this pullback didn't break below 16,850, we will still maintain that short-term bullish outlook on the German 30. Next resistance to watch out for will be 17,130/17,155, which is the top of this ascending channel. And also, if I do the Fibo extension over here, okay, it's coming to 2 times, and as well within the nested Fibo extension, 0.764, okay, which is close at 17,130/17,155 as well. Only an hourly close below 16,850 will invalidate this short-term bullish bias that we have on the German 30 to see the start of another minor corrective decline to test the next support level at 16,620, which is confluencing with the upward sloping 50-day moving average, and as well as the 61% Fibo retracement from the low of 17th of Jan all the way up to the current intraday high right now. Okay, 61.8 Fibo retracement, which is at 16,620. So net still maintaining that short-term bullish bias with an adjusted short-term pivotal support for today. As long as any pullback managed to hold above 16,850, we will still maintain that short-term bullish bias on the German 30 index. US major stock indices, starting with the US Wall Street 30. So US Wall Street 30, within our expectation, it managed to churn higher high and higher low, and now continue to trade, evolve within this short-term minor ascending channel that is in place since the low of 18th of Jan 2024. We will see over here. So all in all, it's almost hitting the resistance that we highlighted since last week at 38,400. So no change. We will be using a tighten key short-term pivotal support for today for the US Wall Street 30, which confluence with the lower boundary of this minor ascending channel, confluencing with the former minor range high of 23rd of January, now turns into a pullback support level. Also confluencing with the lower limit of the minor ascending channel that we could see over here at 38,060. So as long as 38,060 short-term pivotal support holds, in any pullback, we will still maintain that short-term bullish outlook with the US Wall Street 30 using this tighten key short-term pivotal support now at 38,060. First resistance 38,400, a break above it potentially exposes the next intermediate resistance at 38,750, which is the top of this ascending channel, and as well as the one-time Fibo extension from the low of 18th of Jan, project it up to the high of 23rd of January towards the minor low of last Thursday at one-time Fibo extension. 38,750. All right. So, however, if we start to see a breakdown below 38,060, then we could kind of negate this bullish bias to see another round of minor corrective decline within a short-term uptrend phase. Why short-term uptrend phase? Because the price action is still holding above the 20-day moving average to retest last Thursday's swing low at 37,800, which is the former range resistance that is in place since 29th of December, tested on 12th of Jan, now turns into a pullback support at 37,800, which is also confluence with the upward sloping 20-day moving average. So net no change, still maintain that bullish bias on the US Wall Street 30, except that we'll be using a tighten key short-term pivotal support for today at 38,060 level in any pullback. If this pullback didn't surpass below this level, next resistance to watch will be at 38,400, followed by 38,750. Nasdaq 100, so no change on the Nasdaq 100 as well. Using a adjusted pivotal support for today at 17,330. So what's 17,330? Minor swing low area of 20th of Jan, and almost similar to last Friday's swing low, and as well as the median line of this minor ascending channel that I drew from the low of this year from 15th of November. So net overall no change as long as 17,330 short-term pivotal support holds. Next resistance level to watch will be 17,750, followed by 18,000/18,030 level. Okay, only an hourly close below 17,330 will negate this short-term bullish outlook on the Nasdaq 100 to kickstart another round of minor corrective decline within its short-term uptrend phase to expose the next support level at 16,910, which is also confluence with the closely with the upward sloping 20-day moving average. All right, so overall, no change. If you look at like share if you're on the major benchmark stock indices, still maintaining that short-term bullish outlook with their respective adjusted short-term pivotal support level. Only the Hang Seng 33 index, we are still maintaining that bullish bias, but that bullish bias is only evolving within a minor corrective counter trend rebound phase within its medium-term downtrend that is still intact for the Hang Seng 33 index, or the Hong Kong 33 index we call it. Now, FX market. So let us start with the Asia Pacific market first. Aussie dollar. So Aussie dollar going to actually shape that burst up above that former first resistance that we highlighted yesterday, late last week at 66 pardon me, 66.14 level, 66.14 level. So it break out, but there's no follow through now in time to trade sideways. So but however, the RSI didn't shape any signs of bearish divergence upon hitting the overbought level. So what you could see is that price going to shape higher high, or you could see there's no lower high on the hourly RSI. So with that, right, we'll still maintain that bullish bias, but we don't want to have a tight short-term pivotal support level just in case of any whipsaw. So we'll be maintaining that short-term pivotal support at 65.70. We're also conferencing with the bottom of this range configuration, minor range configuration, and also slightly below the 200-day moving average, where price action has managed to surpass it and trade above this level yesterday. So as long as 65.70 short-term pivotal support holds for now, we will still maintain that short-term bullish outlook on the Aussie dollar. Next resistance level to watch will be at 66.50, while 66.50 also confluencing with the 20-day and the 50-day moving average, and as well as the 38.2% FIBO retracement of the previous down move from 28th of December all the way down to the low of 17th of January low. Okay, so this is the next resistance to watch. Above 66.50 potentially takes us up towards 67 figure level, which is the congestion area over here from the 12th of Jan and 15th of Jan this year, and as well as the 50% FIBO retracement from the high of 20th of December to the low of 18th of January. So net overall still maintaining that short-term bullish bias as long as 65.70 short-term pivotal support holds on the Aussie dollar. Only an hourly close below 65.70 will negate this bullish tone to see another round of choppy decline to retest the medium-term support level at 65.20. So that's for the Aussie dollar. Dollar yen. So dollar yen going to move down lower in our expectation and broke below this kind of what I call formally minor bearish ascending wedge configuration. It broke down the lower limit. So right now turns into a pullback support at 147.65 level, around this level over here. So with that, no change. I don't want to put it so tight right at this 148 figure, 145.60 level. So I was still using this 149.80 as my short-term pivotal resistance. So as long as 149.80 short-term pivotal resistance is not surpassed, we will still maintain that short-term bearish outlook on the dollar yen, with the first support level to watch out for will be at 146.25, which also confluence with the minor swing high area of 11 of Jan, now turns into pullback support, and as well as also conversing with the upward sloping 20-day moving average, now acting as a support also as 146.25 level. So as long as 149.80 short-term pivotal resistance is not surpassed to the upside, we will still maintain that short-term bearish outlook. First support level to watch will be at 146.25 on the dollar yen. Only an hourly close above 149.80 will invalidate this short-term bearish bias of the dollar yen to see a squeeze up to test the next resistance level at 150.20/70. Okay, now European currency. So European currency over here will be a bit of a mess right now. The sterling dollar continue to trade within this symmetrical range configuration that is in place since 28th of December. Okay, this is a symmetrical triangle range configuration. So no change, right? The upper limit of the range will be at 27.60. So it's a kind of sideways range configuration. So still maintaining that neutrality range between 127.60 and 126.40 for now on the sterling dollar. And we have a choppy move on the European currency yesterday, the euro dollar. So euro dollar continued to actually trade below the 20-day moving average. It broke down before shaping that recovery, but didn't manage to surpass above the 200-day moving average. So where it stopped over here, right? If you do the FIBO retracement, it actually stopped at the 50% FIBO retracement of that push up from 3rd of October last year all the way up to 28th of December last year. Okay, it stopped at the 50% FIBO retracement of this we call it ongoing, what we call messy corrective decline. So with that, right, since it stopped at the 50% FIBO retracement, technical elements rather unclear right now, so I do not want to maintain that bullish bias anymore. So I will be flipping to a neutrality stance for today for now, between 1.0795, which is yesterday's swing low area before that recovery took shape, which is the 50% FIBO retracement that I highlighted to you all. Upper limit will be at 1.0907, which confluence with the 50-day and the 20-day moving average, I think, as a resistance as well, and also confluence with this minor trend line, minor descending trend line resistance that I draw from the high of 11th of Jan and 24th of Jan, now acting as a resistance also at 1.0907. So neutral between 1.0907 and 1.0795. Only an hourly close below 1.0795 will expose the next short-term support level at 1.0740. All right, so net overall, we do not see any clear signs of dollar strength resurgence back yet, because what we could see right now is the Aussie dollar is gaining strength, and the yen is actually also slightly strengthening against the dollar. So kind of sideways of the sterling dollar. Yes, euro dollar is weak, but it's showing mixed element at this juncture. So net overall, no clear signs of dollar strength resurgence ahead of the important FOMC meeting on Friday, and not on Friday, on Wednesday, and as well as the Treasury announcement of that refunding program also coming on Wednesday as well. Okay, so overall, before that is the short-term technical outlook on the FX market. So now let's immediately jump on the gold. So for spot gold, right, no change on spot gold. So spot gold, what we could see over here is that price going to churn within this 2015 level. So what we could do over here is that 2015 level will be my short-term pivotal support level. No change as well for today. ST pivot. Okay, let me highlight. Okay, ST pivot. Okay, so what we could see over here is that there is a bullish breakout, momentum bullish breakout over here that was tested yesterday and shaped a higher low. So net overall, right, no change. 2015 short-term pivotal support for sure. Right now, price action now trying to close above the 20-day and the 50-day moving average that is getting compressed together. So indicating to us there is going to be a volatility breakout soon. So if we start to see a bullish breakout above 2040 level, so potentially, right, what we could see over here is that we could start to see a minor bullish breakout towards the next resistance level at 2060, which is confluencing with the minor swing high of 5th of Jan and 16th of Jan. Above 2060 potentially take us up towards the minor swing high area of 28th of December at 2090. So overall, still maintain that short-term bullish outlook for that impending volatility bullish breakout. However, only hourly close below 2015 will invalidate this bullish bias to see another round of choppy decline to test the medium-term pivotal support at 2000 level. Okay, so that's for the outlook for spot gold XAU/USD. So still maintain that short-term bullish outlook with that potential impending bullish breakout that is coming in sign, given the momentum bullish breakout that's been seen earlier, and as well as the compression of the 20 and the 50-day moving average right now. Oil, WTI crude oil. So WTI crude oil, no change. We flip to a bullish bias, not bullish, a bearish pattern. We flip to a bearish bias on last Friday. So price action indeed continue to actually trade lower below 78.40 pivotal resistance that we highlighted, and right now reintegrate back to below the 200-day moving average as seen over here. So with that, right, price action right now seems to us to be doing a bit of profit taking activities scenario to do a retracement of that of this last swing up from 17th of Jan all the way up to this Monday swing high. Okay, so the first support level has already been made, broke down 77.40. Next support level to watch out for will be 75.75/75.30. A breakdown below 75.30 potentially expose us up to the 61.8 Fibo retracement of this last push up at 73.90. We're also conferencing with the upward sloping 50-day moving average as well, and as well as the pullback support of this former medium-term descending channel that is in place since 28th of September 2023 high. Okay, so net still maintain that short-term bearish outlook for this potential profit-taking opportunity, profit-taking scenario that is taking place right now for oil price to do a setback further towards the next support at 75.30/75.30. Breakdown below 75.30 exposes 73.90. Only hourly close back above 78.40 will invalidate this bearish scenario to see the continuation of this bullish move to test the next resistance at 79.75 in first step. Okay, so overall net, given that we start to see negative technical elements right now appearing in West Texas oil, so we will still maintain that short-term bearish outlook for this profit taking activities to take shape below 78.40 pivotal resistance, also now supported by the momentum bearish breakdown below this 50-day level, formerly was acting as a support level, okay, over here as well. So that pretty much sum up for today's short-term technical outlook across the various cross asset classes. So before we go, let's take a look at the economic calendar or what are the key data to look out for today. So today will be Tuesday. So what we could see over here is we do have flash data on GDP growth in the Eurozone. So the one that is on the aggregate one will be the Eurozone growth GDP Q4 data, flash data that will be out at 6 p.m. Singapore time. As that's for now. Then we also do have 9 p.m. the IMF will start to release their latest World Economic Outlook report at 9 p.m. Singapore time. And on top of that, we also has conference brought consumer confidence that's out at 11 p.m. Singapore time. And most importantly, for those who are actually looking at the US benchmark stock indices, Microsoft and Alphabet will actually release their Q4 earnings outlook at the close of the after the close of the US session today. That means after 4 a.m. Singapore time. Market is actually expecting a very strong consensus number for Apple and Alphabet at 2.29 earnings per EPS versus the previous earnings announcement at 2.32. Similar for Alphabet as well, 1.59 EPS versus 1.05 that was announced previously. Okay, so a very strong earnings growth, I would say, number for these two mega cap stock. Anything that is disappointing that could actually potentially derail the we call it ongoing risk on behavior on the US benchmark stock market later during the Asia session. So just keep in mind of the levels that I highlighted to you earlier on today on the Dow Jones and as well as the Nasdaq 100. All right. So with that, that pretty much sum up for today's daily dose of market insight. So do have a great day ahead, and we shall speak again tomorrow. Thank you.